Day traders typically classify the trading activity into three sessions. The obvious ones being the opening session, which is generally the first hour of the trade, the closing session, which typically is the last 1 to 1.5 hour of the trade, and the session in between. And day traders have a plan for each of the sessions. Similar plan exists even for swing traders, and like myself in this case, we are looking at the Nifty chart, and here I'm just marking the cursor on 29th of October, which is pretty close to the October series expiry. And when a series expires, at that point in time, a trader is supposed to create positions for the next series. Now this is basically, I'll just move the recording here, visual, and this is basically how we would have seen the expiry end, and almost around that time. So we have set the Nifty on the daily time frame, and this is somewhere approximately the 29th, 30th of October, when positions for November series needed to have been created. At that point in time, it was obvious that because we were seeing a range break on the upside, I'll just mark it with a line here. This pivotal move was actually a break of range, and this is the range which I'm marking with the blue line, and I'll just darken it. So this pivotal move resulted in a break of a range, which causes a temporary change in trend, and the bias shifts on the long side. And whenever the bias shifts on the long side, we are looking towards building positions on the long side for that part of the expiry. Now, once that is clear, we obviously saw the formation of a bearish counter attack, which in a couple of days looked like a double bottom. And we anticipated that if the double bottom would break, it would form a M pattern on the hourly charts, giving it a 25,300 target. So obviously, once the plan was to buy the dips, subsequent dips in the markets were being used to build up positions, but the real bet would have been at around 25,300 levels, which would have been the target of the M pattern. And the general assumption would be that the market might respect the pattern forming on the hourly, but it will also respect the patterns which are forming on the monthly and the weekly, which are bullish patterns. So leading into this, we see that the market does pull back, and it pulled back still approximately 25,300, and it is at this point when a real bet on the market would have been made. Now, once we are in this position, obviously the plan for the trade has been discussed on the series several times. But once we were in this position, we are holding longs, and we are pretty much defending, and the market subsequently gaps up. The critical point about this gap up that the market did a couple of days ago is that it gapped back into the range which it broke. In other words, if I zoom into the video now, into the screen, you will note that there is this gap which the market attempted to fill yesterday during the elections, and this gap actually happens in a cluster, and in a way, it is this gap is what we define as a breakaway gap. Now, a breakaway gap is meaningful because if it is followed up with any other gap in the market, so because we are on a weekend, it's a Saturday, and by Monday, the market could decide whether it wants to gap up or not. But if the market gaps up, and here I'm marking 26,018 as the previous high, so any gap up above this level will now basically, after a breakaway gap, give the market what is known as a continuation gap. And this continuation gap then immediately gives the market a weekly ATR target. So like if you see the previous videos, and as I have mentioned that at least on this series you should see the videos in continuation, because we are building upon the analysis. The analysis is not really changing that quickly. For the analysis to change, the market has to create a new pivotal low. Till that doesn't happen, we are just learning how to form an opinion and then to trade in that opinion. So coming back, one of the scenarios that we have to prepare for because of the occurrence of this breakaway gap is actually the occurrence of a continuation gap. And if the continuation gap happens above 26,018 levels, in such a case, the market would be set up for a target of approximately 500 points from that point, like 26,300 levels from the current closing, that is. Now, this is obviously a bullish anticipation, and the reason for this bullish anticipation, like I mentioned, is the breakaway gap formation here. The question is, what happens if the market decides to, instead of gapping up or continuing on the upside, if the market decides on a bearish continuation, which means that the market gaps down, then in that case, the immediate 25,680, that is pretty much the range low that was previously created, and means the M pattern low and this gap, they start acting out as supports, and it becomes a little difficult for the market to right away take out those supports. The reason why I'm saying that it is difficult to imagine the market taking out those supports immediately is because a major event has just unfolded. The Bihar elections are over, the results are out. It's quite it was a decisive win for the government of the state, and so the event, now that it is unfolded, there are lesser surprises for the market, at least coming domestically. So it's a little difficult to visualize that the market from 25,900 will gap down at 25,600, but it is easier to visualize that this 25,900 is gapping up to 26,050 or something, which would be pretty much aligned with the preceding move that is happening. So all in all, obviously, like I mentioned, that a swing trader would break the month into the opening phase where they are trying to build up the positions. Then the second part of the stage comes where we are in the middle part of the month, say 15th of November, where now the bulk of the positions are bought in this 25,680 to 25,300 range. Now bulk of these positions will be kept open in the market, and we are in the middle point of the range. And the most optimistic scenario would obviously be a breakout of this range. In that case, the expiry would likely close pretty high, and a breakout of this range, like I said, gives it a target of 26,350 on Nifty, which would also be its all-time high. In other words, the pattern is looking like, if one were to take a guess, it's looking like the market could create its all-time high in this trading week, or by this November expiry. That is roughly 9 days in total. The market is looking that it is possible that it will do it. And in that scenario, the positions bought between 25,680 to 25,300 would obviously be doing very, very well. And after a long ranging, as you can clearly see from the month of July right up till October, the market has actually traded at the same levels. So this is right here, July, and this is October. So the market has pretty much given zero returns, and futures traders would have kept paying premium. Or even option traders would keep paying premium. So it looks like finally there is a breakout. And then the question is, who should be cautious in this time? The market is threatening bullish patterns. The market is coming out of a pivotal low. The market has to define the trading range for this particular month. Like, for example, you remember that when we had just worked on planning on volatility, we had seen that the market has an average trading range of 1200 points in a month, and currently the market has just moved about 650. The market has still 650 points more to move, and there is a possibility that 600 points more of move could actually come on the upside. Because of this, it becomes very unsafe to be an option writer, particularly a call option writer in the market. If there is anything, then perhaps 25,650 and 25,300 puts are far safer bet to be written. And then there was a question that was asked, is why don't I write options? And the answer is because I'm in the market where if I am right, then I should theoretically gain a lot. I don't like the idea of limiting my gains. I think it's too difficult a business, it's too difficult a job to work where there are just finite gains. Typically, people who are writing options are usually dependent on other income sources, and they are just optimizing those income sources. In my case, it's the other way around. I'm pretty much depending on the market for the income, so just optimizing a fraction of it doesn't cut it. Maybe if I have like $10-50 million account or something, and I just want to have fun in the market and not work too hard, maybe then I might write options. But in general, I feel to start off as a trader, your career building of options is basically not the right, by writing options is simply not the right way. It makes you very passive, and it simply does not allow your trading skewness to reach a positive high value. which means you never really gain a lot in the market. And in your trading career of 3 to 5 years, if there is ever a black swan event, then you would have realized you just wasted a serious amount of time. So that's the downside risk in futures. Obviously the downside risk is immediate amount of pain, but then there is also the upside potential of some gain, which excites me more. So when I factor it all, I think futures trading is better for me. And I don't do option buying, because option buying, like I've mentioned, is 10 times more expensive than futures buying. So if I were to buy 1 crore rupees worth of positions in options versus 1 crore rupees worth of positions in futures, futures would be much cheaper for me. I mean, when I factor in the brokerage and the STT, etc., futures trading could cost me approximately 1500 rupees, whereas options buying of that value could cost me approximately 18,000 rupees. So, if you're in the business of trading, obviously, if I were buying an option, I would be buying deep in the money options. I wouldn't be buying OTMs. And if I would be buying deep in the money options, which pretty much have the delta of a future, then why would I buy the option when I can get the future at much lesser price in terms of expense? Of course, the contract value is higher. The theoretical gains are theoretical losses are infinite, but because the market could always skip your gap. But I think that my stops are far enough factoring the potential of a gap, and therefore I don't trade options. And I think futures is a better bang for my buck. So I hope I've answered a few questions. I hope that I have tried to lay out the plan. The plan looks like we have to prepare for a bullish move in the market. Obviously, when we took the positions, or when we decided to take the positions, the stop losses are pretty clear. You can just watch the previous video on Nifty, and it is pretty much the same levels that I have marked. And it would be good if you watch perhaps last 4, 5, 7 videos on our coverage on Nifty, because you will see how an assessment from the monthly and the weekly is shaping actions basically on the daily and the hourly. And by that I mean is that while I am analyzing just the Nifty chart, essentially this is captured in the individual stocks, and positions are then created there, that this information is translated there, and actions are taken which are consistent from this assessment. So I hope that through this continuous engagement we are seeing a pattern of similarity in behavior. I also have quite a few other questions in the comments regarding explanations or logics for specific trades. It's a good idea. I think I will cover them, and but at the moment I just thought that I'll continue with Nifty because the price action has become very interesting all of a sudden. This breakaway gap has, if you remember in the previous video, I had basically mentioned that I would be, if this happens, I would typically look for a move like this. I would have expected that this, instead of this gap, this is what is going to happen, right? And then I suggested that eventually this would happen. And the reason why I would prefer this is because, like I mentioned, that my entire capital is not deployed. So I need more time for the entire capital to deploy, and therefore, even though this is the slower up move, this is more favorable for me because it gives me time to buy them. A few more stocks would have corrected. So this would be beneficial in the sense that my entire account would have got allocated, but this would have happened in a much slower market conditions. This was one scenario that we discussed. We obviously always discuss the bearish scenario. Now the scenario that could play out is this one actually. And if this scenario is to play out, then obviously the positions that were created here are happy, but the entire account is now no longer deployed. And because the entire account is no longer deployed, from here, whenever there is a pull back, that capital which was not deployed will start getting deployed, and the market will start taking support, because, and I mean, that's actually how it sort of works in the market in general. So I hope that we can see this in our own trades. I will be happy to answer your queries, of course, and your queries, your comments, give the feedback for subsequent videos. The idea is to practice market assessment using price action, and if you have learned a few things or would like to share your learnings, I would be happy to read them in the comment section. Thank you for liking and subscribing, and thank you for your time.